So today I wanted to give you a bit of background to how banks make decisions around who they'll lend to. And to do that, I'll take you through the 4 C's of credit as it comes to home loans. So the first C is capacity. This is, in simple terms, can you make the repayments? The sorts of things that will be taken into account here are what is your income? What percentage of your income or what parts of your income can the bank include? So some forms of income will be shaded, where they'll use a portion of it if it's not certain, for example, overtime, that may vary. Your expenses, so your general living expenses, what does it cost to keep your household going on an ongoing basis? And then also your commitments. What existing debts have you got? What are the repayments you need to make? And what would they look like if interest rates went up? So all of those factors together factor into your capacity, or what's also known as your servicing. Can you service the debt? There will be other videos you can pick up on to understand how your borrowing capacity is calculated, and also a little bit more around how to estimate your living expenses. But in a nutshell, that's your capacity side of things. The next C is capital. And this really is your contribution. So the deposit that you're putting down, and lenders will also look to see how you will cover the costs associated with your purchase. So that would be your stamp duty, your mortgage registration, the solicitors, the pest and building. They need to make sure that you're going to be able to complete that transaction. Particularly for borrowers who have smaller deposits or your first home buyers, lenders will also look at where your capital or your contribution has come from. They want to see that you've been able to genuinely save that over time, because that does play into the affordability, making sure that they're putting you in a loan that you'll be able to manage. The third C is character. And it sounds a bit of a strange one to be throwing into banking, but it really refers to your credit history and the likelihood that you will repay the debt. So this is where the banks tend to use some statistical representations based on different characteristics. They will look at your credit report, what your credit score is, what your conduct is on debts that you already have, to form a view around how much risk there is that you won't repay that loan based on past behaviour and a range of other factors. We'll talk a little bit more about credit reporting and how that's changing in a separate video. Collateral. So this is where the bank looks at the property that will actually be securing the debt. Are you buying a house? Are you buying a unit? And this can influence lending policy. It can influence which lenders are prepared to lend against your property and how much of the value of that property they're prepared to lend against. So if you are buying an inner city unit in an area that the bank has deemed higher risk than others, they may only be prepared to go to 80% as opposed to being prepared to go to 90, or in some cases 95% loan to value ratio on those loans. So it's not a simple weighting across the 4 C's, but that gives you a bit of an idea of the sorts of things that the banks will be looking at. And this is one of the reasons why we tend to get a fair bit of information before we start, so that we can get a good sense of how you shape in all of those areas, but most importantly, get the information that we need to tell the bank who you are, and let them know factors that may not be immediately obvious from the application that lower your risk as a borrower and strengthen your case for the bank approving your loan.